My name is Matt Hearn. I'm a financial planner with Cannon Wealth Management and LPL Financial. Thank you for joining us tonight. We're live on Facebook as well as on our webinar here on Zoom. And we're excited to kick off episode 7 of our video series airing each second Tuesday monthly at 6 p.m. It's hard to believe that we've done 7 of these already, and we're gonna do more. So we're gonna just keep these going as long as folks give us feedback that they're enjoying it. We've called the series Method to My Money. We're addressing some of the topics we get questions about most often from our clients. Thank you for being here. Some of you are joining via Zoom, others on Facebook. Thank you. Please, if you enjoy this tonight, go ahead and mark your calendars to join us each second Tuesday monthly at 6 p.m. And feel free to share the link, share the broadcast with anyone there that you think might be interested in this as well. In past episodes, we've covered retire without a pay cut, kids in cash, preparing the next generation to make smart financial choices, tax efficient giving, 10 end-of-year tips to trim your taxes. That's a lot of T's there. We did that right at the end of the year with Joey Perkins, one of our partners and CPAs here at Cannon Wealth Management. Finding confidence in your future. We talked about that in January. Finding financial simplicity, getting and staying organized. You can find the replays of these broadcasts on our website, on our YouTube channel, and I believe on Facebook as well. Future topics will include investing in a rapidly changing world, income and expense planning, where did all the money go? That's a topic we're going to be addressing. Leaving a lasting and loving legacy. And then we'll have an episode coming up for our small business owners planning for the next chapter. So lot to join us for. Hopefully some of those, or maybe at least one of those topics, is of interest to you, so mark your calendars there. And we're excited tonight. I've actually got some help, and I think you'll enjoy our speakers and the folks that we've been able to bring to you tonight that are really more specialized and better at this topic than I am. And I'm excited about that. I want to just quickly shout out to Kimberly Stone. She's our marketing director here at Cannon Wealth Management. She is in charge of making sure that we get our everything through our compliance reviews, and then making sure that things get posted in the various places out there on the internet, things that I don't understand how to do, and she's really good at it. So great job, Kimberly. And once again, tonight we're talking about in sickness and in health, planning for healthcare costs in retirement. It's a huge topic. And I do want to take this opportunity to welcome 2 of my good friends and colleagues, and I need to make sure they are able to speak here. Let me unmute their microphones. There we go. And so first of all, one you're probably very familiar with if you're a client at Cannon Wealth Management, Cindy Edwards, our Director of Operations. She helps our clients with everything related to the operations side of the business, opening accounts, funding accounts, closing accounts, following up on paperwork. She is really like the hub of everything we do here. If it's going to get done, Cindy's going to touch it at some point along the way. So welcome, Cindy. Thank you for being here tonight. Yeah. And another thing that she does for us that a lot of people don't realize, Cindy, as we help folks plan for their future, sometimes we uncover a need to either look at an old insurance policy or look at a situation that a client is concerned about where they may not feel like they have enough coverage or enough protection. And so Cindy is really our in-house or resident insurance specialist as well. So she wears a lot of hats. But there's another hat that she certainly wears for us, and she does a great job. Cindy's the person that I go to first when we uncover a need to plan in the area of insurance, and she keeps her finger on the pulse of what's out there in the marketplace and helps us know how to advise our clients in a good way. So thank you for that, Cindy. Appreciate you being here. Another person joining us tonight may not be quite as familiar to you. Mike Mazzoni has joined us, and Mike is with One America, and he has more than 20 years of experience in the securities and insurance industry, managing client relationships, sales, distribution, multiple channels that he works with there. And he has been a great resource. Mike, you've been a big help to us personally, as well as a firm, as we've tried to just help our clients in the best way possible. In his spare time, he enjoys competing in triathlons. He's run several marathons, I believe, much better shape than I am. And I think he might be training. Are you still doing Ironman competitions, Mike?
I am. I do the half irons. I've got 3 kids, so I've got to be able to run away fast.
Okay. All right. Well, I thought about maybe sharing that picture of you with your son on the shoulders. Matter of fact, I may do that real quick. I'll pull that up. I've actually got it. I want you to tell the story if you don't mind, and I'll share this with the audience here. If I can get it to come up. All right. So I hope you can see that okay. The picture is of Mike finishing, I believe, a marathon. And Mike, tell us what's going on here.
This was the Charlotte Marathon a few years ago, and I was trying to qualify for Boston. You get a certain time based on your age. And I thought I had it until I got to about mile 18, and then I had to break down and almost didn't make it. But as I got towards the end, I was just kind of jogging it out. I look over and there's my family, everybody waiting about 100 yards from the finish, and I just absolutely broke down. And somehow I got my 4th wind. I was able to pick up my little guy and cross the finish line with him on my shoulders. Oh. It's very hard to see the amount of pain that went into that picture. Yeah, one of my favorite moments in life. I love my kids, and being able to share something like that was really special.
That is special. You can see it on his face that he is super excited with his dad there. The most I've ever run is a 10K, and I remember the pain from that, and that I can't even imagine running a marathon. So great job.
You'll have to get ready for the next one.
All right. All right. Well, let me unshare my screen here, and we'll. I just wanted to share that with the audience. I think that's a great story, Mike.
Thank you.
So let's go ahead and dive into our topic tonight: healthcare in retirement, healthcare costs in retirement, and how to plan for them. Healthcare in retirement is, as many may already know, but I'll go ahead and just kind of set the stage with some basic concepts here. It's available from many sources. Government programs such as Medicaid and Medicare offer numerous health care benefits. You may need to purchase supplemental health insurance, like, for example, a Medigap type of policy as well. Most Americans are eligible to begin receiving Medicare benefits at age 65, but qualifying for Medicaid may require some planning on your part. In addition to these resources, you may also be entitled to military health care benefits if you're a veteran, retired service member, or the spouse or widow of a veteran or retired service member. Just really briefly, let's talk about 3 programs you want to be aware of. Medicare is a federal health insurance program that was created in 1965. Primarily, Medicare assists those who are age 65 or older. But if you're disabled or have maybe a kidney disease, you may be eligible for Medicare coverage no matter what your age. Medicare currently consists of Part A, which is hospital insurance, Part B, medical insurance, Part C, which allows private insurance companies to offer some benefits, and then Part D, which covers costs of prescription drugs. With each part comes its own set of eligibility requirements. And then Medigap. Medigap is supplemental insurance specifically designed to cover some of the gaps that Medicare coverage may not have for you, or the gaps in the coverage there. Although the name may lead you to believe otherwise, Medigap is provided by private health insurance companies, not the government. However, Medigap is strictly regulated by the federal government. There are 10 standard Medigap policies available. Plans E, H, I, and J are actually no longer available for sale. However, if you already have one of these plans, you can keep it. All plans may not be offered in your state, yet all are standardized and certified by the U.S. Department of Health and Human Services, so that each plan, will cover exactly the same kind of coverage no matter what state you live in. The only exception would be Massachusetts, Minnesota, and Wisconsin. They have their own standardized plans. They have to be different, right? But here in North Carolina, that they are standard across the rest of the U.S. Every Medigap policy offers certain basic core benefits, such as coverage of certain Medicare Part A and B coinsurance and copayments. And let's see, I almost lost you there. I think everybody's back. All right, good. And then the last one I want to just briefly mention is Medicaid. Medicaid provides medical assistance to aged, disabled, or blind individuals, or to needy, dependent children who could not otherwise afford the necessary medical care. Medicaid is really, think of it as a catch-all for those folks who have run out of resources, or maybe they just don't have the resources to pay for medical care on their own. Medicaid pays for a number of medical costs, including hospital bills, physician services, home health care, and long-term nursing care. But again, it's only for those who qualify because basically they're out of resources. Each state administers its own Medicaid program based on broad federal guidelines. Within these guidelines, each state performs the following. Number one, determines its own eligibility requirements. Number two, prescribes the amount, duration, and types of services. And number three, chooses the rate of reimbursement for services. And then each state oversees its own program. So those are the three basic programs, the three main programs that you need to be aware of as you're planning for healthcare costs in retirement. I'd like to focus our attention now on what is often the biggest concern for retirees, a potential healthcare cost or situation that for many, and for probably most of the folks listening tonight, is not covered by Medicare, Medigap, or Medicaid. And that is what we call long-term healthcare costs, long-term healthcare. According to a 2019 Genworth study, the world's population is aging at a faster rate than ever before. People are living longer and longer. Every day until 2030, there are approximately 10,000 baby boomers turning 65. 7 out of 10 people will require long-term care, some form of long-term care in their future. How much does this kind of care cost? Well, in 2020, and I just pulled up the numbers from Forsyth County, North Carolina, that's where this is being aired tonight. Home health care services averaged $3,909 per month. Assisted living services averaged $4,500 per month. And if you need to stay in a nursing facility, the costs are much higher, averaging $7,787 per month for a semi-private room. It's not a private room, that's a semi-private room. 70% of Americans age 65 or older will need some form of health care. We already talked about that, but I just want to reiterate how important it is to plan for this, because we've seen it as financial planners. We've seen how this can really blindside people as they go through their retirement years. We want to get into the meat of our presentation tonight, but before we do, I'd like to ask Cindy, thank you again for joining us, Cindy. I would like you to share something that you just recently, I believe, came across with a client. You were working with an elderly lady that's one of our clients, and without sharing the name, if you could just share the story and really what was surprising in that situation.
Okay. Well, Matt, I'm really glad to join you guys tonight. So one of the things we're currently seeing is that with some of the older policies, we're seeing significant increases in premium. I had a tax client sit down with me. She had received an offer from her insurance company. They gave her 4 choices. One was to keep the policy as it was. Second choice was to reduce her benefit by about 60%, paying the same premium. reduced her policy by about 75% with a reduction in her premium. And the last one was a little bit, she got a lower premium, but she got a lot less benefit. But the scary thing was, even if she maintained a policy that she'd been paying on for nearly 18 years, her premium over the next 3 to 6 years was promised to go up 119%.
Wow.
It's scary. When you're on a fixed income, it's hard to know what to do. So,
absolutely. Wow.
and
Thank you for
she, like I
sharing
said,
that.
she's paid on it for 18 years. So there are other options out there.
And thank you for sharing that. And it's certainly hard to plan when you don't know what the insurance company is going to do. I mean, it really, we can plan, we can put all these numbers in place for folks, but we get a surprise like that, that can certainly throw a monkey wrench into the financial plan.
Well, a couple things we
sharing
talked
that.
about. The client regretted that she had not paid that in 10 years, that she should have actually taken a 10 pay, then she would not be in this situation.
Right. And what you're referring to is the option, the clients can have the option to go ahead and pay their premiums, pay a higher premium in the first 10 years, right?
Be done with it.
And that allows it to be finished and done. Okay. Yeah.
Yeah.
That's
Yeah.
a good. It's surprising, and you have to be so careful just in general with insurance. The insurance industry, let's face it, it doesn't have the best reputation, and it's important to work with people who are independent of, in other words, they're not working for the company, that they are actually working for you, and that they have options to shop around. I love the fact that I can come to Cindy, and she will sometimes recommend that we look at One America. Sometimes she'll recommend that we look at another company, based on really what's best for the client. And I think that's just really important. So thanks for sharing that. Want to go ahead and get into the meat of our presentation tonight. Mike, you have shared this presentation before. You've come out and shared this with folks here at our office. And now in the world that we're living in with the pandemic and certainly the concerns about meeting in person, you've had the opportunity to share this online through webinars all across the country, right?
I have. I really like to focus on providing an education. I do this type of planning because of what I've seen firsthand in my own family. I actually can remember back when I was 5 years old, 40 years ago, and I went to see a grandmother who was in a Medicaid facility. Now, I'll touch on Medicaid. As you mentioned, it's a government program, and the level of care is typically not ideal. It's just not something we would usually choose for ourselves or for a loved one. When we talk about planning for long-term care or planning for extended care, this really is not about insurance. This is about the overall financial plan. So, Matt, one of the key things you said several times was planning, because everybody's different. Not everyone's going to need care, and certainly not everyone needs insurance. But we like to look at this from the overall financial planning perspective. And there are a number of different ways to plan to protect assets, to protect your legacy. Really, this is about preserving someone's ability to choose the type of care they receive, but then also in the setting where they would like to receive care. Not everybody's going to need care, but I find most people, when they get to that point, they still want to have a choice. And that's where it's so important to have this conversation ahead of time to understand how these costs could affect your overall financial plan, and if you need to take steps to mitigate that. So I love working with you and the team, because you have the ability to represent the client to the world of different solutions out there. I've been doing this for about 20 years, and I only work with financial advisors. To me, that's so important. And I think that's where this industry has kind of gotten this type of planning a little bit wrong, because this really started out primarily as an insurance-focused conversation. And it's not about that. It's really about the overall financial plan. So I'm going to dig into a couple of different topics specifically around planning for these extended care expenses. But I'm going to cover this sort of a high level, kind of big picture. I'm going to walk through some different areas of planning because this conversation has changed significantly over the last 40 years. We are living longer than ever before. We're living healthier in retirement. So we're needing care at greater rates, and we're needing care for much longer than ever before. And Matt, you touched on it. We've got 10,000 people a day turning 70, and that's going to happen for about the next 20 years. So we are barely even starting to see this being an issue. Already, the demand for care services is far outpacing the supply. And so it's continuing to drive the costs up. Now, I'm not going to spend a lot of time on statistics or averages. You touched on some of the averages. Certainly, we know the costs are continuing to increase. One of the numbers that's changing is the average length of care. Now, average length of care for a man is about 2.2 years. For a woman, it's a lot longer. It's closer to 3.7 years. This is clearly an issue that affects women to a much greater degree and to a much greater extent. So it's important from a planning standpoint that we look at overall income and expenses, and just like any financial planning, we try to identify potential risks to that secure retirement income. And if it makes sense for someone's situation, we look at ways to mitigate those risks. Now, remember, I talked about some averages, we talked about some costs and some different statistics. Those are averages. An average is right in the middle. So half the people go past that. Now, when it comes to something like Alzheimer's or dementia, our average length of care is closer to 8 years. Now, I had a grandmother more recently who had dementia, and she had dementia for 9 years. So I've seen firsthand how important it is to plan for these situations. Now, I'm going to go into a couple of different concepts, and I'm going to talk about some different ways to plan for these extended care expenses. You're going to hear me use the words extended care throughout this presentation. I find the words long-term care, they immediately think of a nursing home. And again, this is really preserving your ability to choose. Most people I do this type of planning with say, Mike, I want to stay at home as long as possible. And that's, again, where having some type of plan is important. I have talked to some clients over the years that said, hey, Mike, my plan is I'm just going to go to a facility and let them worry about it. I feel like over the last year, more and more people are seeing firsthand why it's important to preserve that ability to choose.
Yeah, absolutely.
So keep that in mind. We're going to talk about this.
Yeah, yeah.
So I'm going to go ahead and switch over to my whiteboard.
Oh, you're fine. And as you do that, I'm going to just interject real quickly. We have a question and answer section at the bottom of the tabs there at the bottom of your screen. So as you listen to Mike share, feel free to send us a question. Here at the end of our time tonight, we will read those questions and one of us will do our best to answer them for you. So.
Yeah, glad you mentioned that. Sorry I can't be with everybody in person. I prefer to be there in person to answer questions, but this kind of is what it is right now. So the good thing is if I cough, you don't have to worry. Now, there are a number of ways from a financial planning standpoint to work through protecting assets and preserving that ability to choose. Now, by default, everyone does actually have a plan, whether you realize it or not. By default, everyone has a plan. Of course, most people fail to plan. So by default, that plan is no plan. If you choose not to decide, you still have made a choice, right? Now, some people will call this self-funding. You may have heard that term, self-funding. Now, that simply means that you have to pay dollar for dollar out of pocket for whatever those care costs end up being in the future. So failing to plan sometimes can be planning to fail. That can be a recipe for disaster. When we talk about needing care in the future, from a financial planning standpoint, ultimately all that is another expense in retirement. It's an expense that may or may not occur, but it's something that we can plan for. I don't hear this as much anymore because more and more people are seeing family and friends affected firsthand. They're seeing the costs continue to grow. If I do hear this, it's usually one of three things. The first thing is either, well, Mike, I've never had this conversation. I didn't realize that this is something I need to be thinking about. A lot of times it's just a lack of awareness. The second time I'll hear this is, well, Mike, I've got a crystal ball and I know I'm never going to need care. Or if I do, I'm only going to need it for a year or two. Well, of course, we don't have that crystal ball and we just don't know. I find most people that I have this conversation with, they have some assets. And so we really want to look at this again from the holistic financial planning standpoint. So the crystal ball doesn't work. Now, the last time I'll hear this is if somebody is really just fixated on the averages or if they think a government program is going to pay for care. Now, Medicare and Medicaid do a number of different things, but neither one of them is designed to pay for care from a financial planning standpoint. What Medicare and Medicaid will do is they'll give us a little bit of help, but for a very short amount of time. Or, as Matt mentioned, we have to be destitute. We have to have no resources and no means at all. Now, for Medicare to be involved at all, you actually have to have an acute injury or illness. You have to get sick or hurt, and it requires 3 nights of a hospital stay. And then Medicare will pick up 100% of care, but only for the first 20 days. So just a short amount of time. Starting day 21, there is a $170 a day copay. And that applies from day 21 through day 100. So the costs jump pretty quickly and they jump pretty dramatically. Now, that $170 a day copay applies, but Medicare is only involved in the first 100 days if the doctor certifies that it's rehabilitative care. So the doctor has to say, this person's going to make a full recovery, they're going to walk out of here fine, they're not going to need any more care going forward. As soon as the doctor says they're no longer going to make a full recovery, they're going to require ongoing care, then Medicare pulls out even in the first 100 days. So remember, you have to get sick or hurt, 3-night hospital stay, then Medicare picks up 100%, but only for the first 20 days. Starting day 21, $170 a day copay, assuming that it's rehabilitative care. So just a little bit of help for a short amount of time. Now, of course, the other government program being Medicaid, that is only for people that are destitute. You have to have spent down all of your resources. Now, Medicaid will allow you to keep a home within a certain value, depending on where you live. You can keep an automobile, but you can only have $2,000 in the bank. You have to spend everything else down until you're destitute. And when Medicaid steps in, you lose all ability to choose. You essentially become a ward of the state, and you have to go wherever they happen to have an open bed. Now, one of the worst stories I've heard was actually in a seminar I did a couple of years ago. The lady raised her hand and she said, Mike, 4 years ago, my mother was diagnosed with Alzheimer's and she was 89 years old. She had about $400,000 in the bank. So they figured 89, Alzheimer's, $400,000, they're probably going to be okay. Of course, fast forward a couple of years, 4 years in that nursing home, they spent all $400,000. So Medicaid stepped in. Now, this lady's mother had been in a semi-private room She was paying $100,000 a year. Because her money was gone and Medicaid stepped in, now she's forced to go down all the way to the end to the Medicaid wing. There is an imaginary line that she's not allowed to cross, so she can't even go down the hall to visit with the people that she lived with for 4 years when she was paying out of pocket. Now that Medicaid's involved, she went from that semi-private room with one other person. Now she shares a room with 5 other people. The medication is different. The food is different. The level of care is different. Medicaid reimburses these care providers pennies on the dollar. And fewer care providers are accepting Medicaid because they don't want to deal with all the red tape of getting reimbursed from the government. So most people I have this conversation with, they just don't want to rely on a government program. We know government programs change. And typically, they shouldn't be that integral part of our plan for providing care. Now, the second way to do this type of planning was actually the first plans that came out. And that's what Cindy was talking about with these rate increases. So the first insurance plans that came out to help with this area of planning are called traditional or health-based long-term care. These plans came out 40 years ago, and they have gone through a significant amount of changes. So traditional long-term care, this is what's typically sold by insurance agents. And these are the plans that have had significant rate increases. Most of the companies that used to offer these have completely gotten out of long-term care because they took on way too much risk, way more than they thought. Because these plans were new, unfortunately, there were some key assumptions the insurance companies got wrong. Now, one of the biggest things they got wrong was overall interest rates. Any insurance you own, the price in part is built on interest rates. You send a premium payment in to the insurance company, right? You pay your premium. The insurance company actually invests that money in what's called their general account, so it can grow so they can pay their claims down the road. So insurance products are very sensitive to interest rates. Well, when these came out 40 years ago, think mid to late 80s, we had significantly higher interest rates. We had double digits. Well, now we've been in such a low interest rate environment for such a long period of time, it's had a dramatic effect on these policies. The insurance companies aren't earning enough on their investments to pay those claims. So this low interest rate environment has forced insurance companies to raise the price of these policies up, in some cases pretty significantly. Now, the second big thing they got wrong was the overall market for people that are having this conversation. So there was an assumption that it was going to be mainly people 55 to 75 years old that were going to be doing this planning. So they thought there'd be kind of an even spread here. So they thought, well, some of these younger clients are going to pay more premiums to offset some of these older clients that are probably going to go on claim sooner. They thought there'd be an even grouping here. Well, you get about 15 years into these type of plans, the average issue age was actually closer to 72 years old. So the insurance companies started realizing, oh no, we're taking on more clients that are probably going to go on claim sooner. They weren't getting enough of the younger clients to offset that. Now, this has changed dramatically in the last decade. I've had more of these planning conversations with clients in their 40s and 50s than I ever would have thought, because they're seeing how their parents are affected. But the first 15 years of the traditional policies, significantly more risk than they thought they were taking on. Now, the last big thing they got wrong was what we call the lapse rate. Now, the lapse rate, I know that sounds fancy. This is very simple. All this refers to is that there are a number of policies that people take out that for whatever reason, someday they just wake up and say, I don't think I need this. They stop paying their premium and the policy lapses or goes away. So the insurance company's off the hook. So insurance companies know there's a number of policies where they're going to take in some premium payments. They are never going to have to pay anything out because that policy is going to lapse. So they can build that into the pricing. So because these policies were new, the only thing they had to look at was life insurance. When you look at life insurance, over the first 10 years of a policy, about a third of them lapse. So a third of the time, the insurance company's off the hook. So they made the same assumption here. Well, what actually happened? Nobody gives these up. These are so important to the long-term viability of the financial plan. Nobody lets them go. So instead of lapsing a third of the time, these lapse about 2% of the time. So 98% of the time, the insurance company is on the hook. They're going to have to pay out a benefit. So these are the three main factors that have forced these type of plans to change significantly. Now, very important, if these are used in the correct way, these can be incredibly valuable. If you have ever known anyone who's gone on claim with one of these policies, they'll tell you it was the best money they ever spent. This is pure insurance protection, so it is the most leverage you can get dollar for dollar. But there are three major complaints that I continue to hear about these. One is, Mike, I bought this thing 20 years ago. I've never heard from my agent again. I don't even know what I have. If you have one of these policies, Cindy can review it, make sure you understand exactly what you have and how it's going to work. So I find that reviewing these is very important, but I have never once recommended anyone drop one of these policies. The two bigger complaints I continue to hear are, one, no guarantees, and prices can keep going up. Just like Cindy saw, one of the worst cases I saw was an 87-year-old who had had one of these for 20 years. She was getting her 5th premium increase, and it was a 70% increase. And it wasn't about the money. She had all the money she needed, but she was 87 and getting another increase. It was more of an emotional, like, how could they do this to me? So the lack of guarantees can be challenging from a financial planning perspective. Sometimes these policies are in place 30 or 40 years before we need them. So guarantees can be important. The last complaint I hear about these is that these are use it or lose it. Works like fire insurance on your house. So the house has to burn down to pay a benefit. So Mike, I could pay premiums for 30 years. If I never need care, all that money goes into a black hole. And they're right. So I don't see this as much anymore. There's only a handful of carriers left that are even doing these, but they can be valuable if they're used correctly. So the third way and the last way to do this type of planning is what we call asset-based long-term care. Now, these plans are not new. The company I work with has been doing this for over 30 years. These solutions were created through pieces of legislation that the government has passed, and also changes in the tax code. The government's trying to give people incentives to do this type of planning on their own. Government is not able to pay for care. Now, there are a number of ways to implement these strategies. These are not cookie cutter, one size fits all. These solutions are designed to be customized towards someone's overall financial portfolio. There's a number of ways to do this. We can use qualified money. We can use old assets that aren't doing anything. But we like to look at this from a financial planning standpoint. Everybody's different. The number one goal is we have to make sure there's enough income in retirement. That's always goal number one. But when we look at the biggest threats to that secure retirement, it tends to be those care expenses in the future. You know, if all of a sudden you're moving along in retirement and now you have another bill that's going to be $80, $90, $100,000 a year, we've got to find something in the financial plan to pay for that. So if we can identify that asset or income stream that's not needed for retirement income, if someone's young and healthy, we try to get leverage to try and protect the rest of the assets. So like any financial planning, all we're doing is identifying an asset in the plan to allocate ahead of time towards these expenses. Now, there are a number of ways to do this. I'm going to give you one quick case study just to give you an idea of how these solutions work. Now, they can all be broken down very simply into a couple of pieces. The first piece, our base policy, is what we call survivorship whole life. Now, I know that sounds fancy. This is very simple. When you hear survivorship, that means two people. So we have the ability to have two spouses on a single contract. I like that from a planning perspective. I don't like to talk a lot about statistics or averages, but there's a really good chance 1 out of 2 is going to need some type of care. I don't want to guess who it is. I want to make sure they're both protected. We do individual contracts as well, but we are the only ones who protect both spouses on a single contract. So that's all that means. Whole life is the oldest type of insurance there is. It's all built on guarantees. So this is very different from those traditional plans. These plans are very black and white. What you see is what you get. Sometimes these are in place for 30 years before we need them. So guarantees can be important. So this just means up to 2 people on a guaranteed contract. The second piece is what we call the continuation of benefits, or the COB for short. This is what allows us to maximize our leverage. We can provide up to a lifetime benefit if someone can qualify. Now, this isn't always appropriate for everyone, but I find most clients I have this conversation with, their concerns are things like what happened to my grandmother in her 9 years of dementia. I find most people, if they need care for a year or 2, a lot of times they have that. They have those resources. But if combined, we need care for 3, 4, 5 years or longer, this helps put an ironclad shield around the portfolio. Now, with this type of planning, there's only 3 outcomes. The first thing, and the most likely thing, is people are going to live a long life. If you live a long life, at some point you get sick or frail, need some type of care. That's the most likely thing to happen. Now, of course, not everybody lives a long life. You could just pass away. And the third thing, you can quit. So live, die, or quit. If you can come up with a 4th outcome, I will change my whole presentation. I actually had a pastor a few years ago who came to one of my seminars, and he said, "What about the rapture?" Well, that's probably in here somewhere. Who knows? We could be in the rapture right now. But usually live, die, or quit, that's about all we see. With this type of planning, in each case, there is a contingency, or there's some benefit. Now, just to give you an idea how this works, I had a husband and wife last week who were 60 years old, and asked them that very simple question. You may never need care, but if you do, what money would you want us to spend first? And they had looked at the averages of $100,000 a year for care and 2.2 to 3.7 years. And they had actually set aside about $200,000 specifically for those care expenses. Now, everybody's different. Some people do more, some people do less, some people spread it out over time. My own mother, when we did her plan, she had enough for a single premium, but she chose to do a 10 pay because she's a business owner and she likes deductions. Cindy referenced that 10 pay earlier. I find most people don't want another bill forever. So usually 10 pay is about as far out as we'll go. But most people, they just want to be done with it. So I find most times it's either a single premium or a 10 pay. We can spread the payments out all the way to age 95, but I find most people don't want another bill forever. The key thing to remember is there's a number of different ways to do this. I just want to give you one example so you can see how the numbers work. Now, in this example, they use that $200,000 all at once. If they quit, if they change their minds, let's say 20 years from now, we cure Alzheimer's, no longer a concern. Well, because of this whole life chassis, they have guaranteed cash value. So this remains a conservative asset in the overall portfolio. The money continues to grow. Now, every once in a while, someone will ask, well, what's the rate of return? How does that grow? I always want to come back to, remember why we're having this conversation. This is not the money designed to build your wealth. This is designed to protect the rest of the wealth that you've already built. But people like to know that, well, if things change, I can get some or all of my money back. Just depends on how we design the contract. Flexibility. In this example, let's say they pass away, never need care. This provides a death benefit of $250,000. Now, we're not really buying it for that either. This is more of an ancillary benefit to recover the cost. This was money that they wanted just to go to their children. Well, now if they never need care, this goes tax-free to their beneficiaries. Children, charity, trust, wherever they want it to go. Now I'm going to put that 250 up here. We'll come back to that in a second. If they live and need care, the most likely thing to happen, this pays a benefit of $90,000 per year. But remember, we've got them both protected. So that's also per person. If both of them needed care at the same time, this would pay out $180,000 per year. And this continuation of benefits made these numbers lifetime protection. So this never runs out. And we have a Ronald Reagan situation. He had Alzheimer's for a decade, something like my grandmother, dementia for 9 years. This pays a benefit as long as either or both people need care. So this helps put an ironclad shield around their portfolio. Now, every once in a while, I'll have someone ask, well, Mike, what if I just left this money invested? Think about the rate of return you would need on $200,000 to generate $90,000 a year. You'd need a 45% rate of return. Matt is a great advisor, but the market is not designed to give us 45% returns consistently. So that is the power of insurance. And what I like about the way these numbers work, either one of these clients need care for even an average amount of time. They're very likely to spend this money. By repositioning ahead of time towards an expense that's likely to occur, well, no matter what happens, they're going to recover their cost. If they never need care, the beneficiaries get more than they would have gotten, and it's tax-free. If they do need care, even for a little bit of time, they're going to recoup their cost, but now they're both protected if something long-term happens. So I wanted to give you some numbers just so you have an idea of the power of some of these solutions. But of course, everybody's different. You don't have to be a marathon runner or a triathlete, but you do have to be, in general, decent health to be able to qualify. So it's so important. Again, it's not about insurance. Everybody's different, but it's so important to have this conversation proactively so you can understand how these risks can affect your overall financial situation, understand how it could affect your portfolio and your secure retirement income. So, Matt, I'm going to go ahead and switch my camera back, and we're happy to take any questions. I want to be conscious of everyone's time.
Thank you, Mike. I really appreciate that. I've heard that presentation a couple of times, and every time I learn something. I really appreciate it. I'm going to go ahead and bring Cindy back in here as well. Let me try to get her back on board here. All right. Yeah, we do have a few questions, and thank you for those who submitted these. The first question I see here is, what if I buy long-term care and never need it, or buy I'm assuming long-term care insurance and never need it? I know you addressed that, Mike, and I appreciate the question. Sometimes it's good to kind of just, think about, okay, I'm putting all this money aside for long-term care. If I don't need long-term care because I'm healthy and I'm, 99 years old and the rapture happens or whatever, what happens to that money?
So with the traditional plans, that money is gone. It is pure insurance coverage. And so it's like maybe some of the other insurance you own, right? You pay that homeowner's insurance, but you certainly hope your house never burns down. Unfortunately, with the traditional plans, that premium goes into a black hole. It's gone forever. So from a financial planning standpoint, I find that's where the traditional plans are a little challenging. There's no real cost recovery feature. And so that is one of the biggest complaints on those policies that I continue to hear. the asset-based plans over the last decade have been the largest area of growth in this type of planning, specifically because of the guarantees and the cost recovery. I find everybody's different, but most people don't want that money to just disappear. They want to make sure that, hey, if I don't need care, I at least want somebody to benefit from that money. Usually it's the children or charity.
Absolutely. And then they also have some tax benefits too. If you pass away and you leave that money and you as a life insurance plan, it can be tax free. And then also if it's pulled out and used for long-term care, it can be tax free. So some real benefits there. Of course, we don't have our CPAs here tonight, but certainly those are some benefits. You got to tell me, Mike, I'm sitting here watching you. I'm trying my best to pay attention. You've got swords behind you. I believe those are swords, right? What's going on here?
They are. My mother was an English teacher, so I grew up with stories of King Arthur and the Knights of the Round Table. Actually, this big one here I actually cut my wedding cake with. My wife is a very patient woman.
Okay, well, it might have been more efficient. You cut with something like that, you'll be done faster. I don't know. Cindy, this might be a really good question for you, and I think this might be right down your alley. What are some things to think about, some things to avoid as you're shopping for long-term care insurance? We know certainly there's the advantage of doing a plan first. We know there's an advantage of working with someone we talked about that has access to many different companies, right? What are some other things we can think about that might be things to avoid when shopping for long-term care?
Well, I don't know about avoiding, but I think you should always weigh in the fact that you need an inflation rider. That just because the numbers you gave earlier are numbers today, they're not going to be the same numbers 10, 15, 20 years from now. You definitely want to make sure that your policy grows with inflation. I think that's one of it's key. It's key, or it's not going to cover anything 20 years from now. So
hugely important. Thank you. It's one of the fastest growing parts of the inflation. As you talked with people about inflation, I mean, healthcare costs in retirement, those costs are going up faster than just about anything else. So good point. You have anything you'd like to add to that, Mike? Anything we should be thinking about as far as what to avoid when we shop for long-term care insurance?
Well, I think that you hit the nail on the head when you said somebody who has multiple options available. That's why I think working with a group like yours is so important. I do see there are still advisors out there that are selling only proprietary products. So they're only selling stuff that their company makes. And to me, that's almost an inherent conflict of interest. I want to work with a planner who has multiple ways of planning, not just one set of tools. So that's why I think working with an independent office like yourself is so important.
Okay. Got time for one more, I believe.
One last thing I would add is make sure you look at the ratings of the carrier.
Yeah.
That is incredibly important. The piece of paper is only as good as the company behind it.
Yes.
And we need this stuff to do what it's supposed to do 30 years from now. So the company ratings are incredibly important when we look at this stuff.
Probably more so than any other area of insurance, really, because you're right. I mean, sometimes you can purchase this when you're 60 and not need it till you're 90. So very important that they
going to be around.
And then we talked briefly about tax breaks available for long-term care insurance. Do you want to speak to that, Mike? I got a question here about tax breaks. And I know we mentioned it briefly, but we are in tax season, and sometimes there are some deductions available. Is that your understanding?
Yes. Now, I teach a lot of CPAs, and there are a couple of restrictions when we try to deduct long-term care insurance personally. So personally, if I want to deduct anything, I need to be itemizing my taxes, and the standard deduction is pretty high. So most CPAs tell me they're not itemizing like they used to. So that can be a big hurdle. If you are itemizing your medical expenses plus any premiums for medical insurance, and that's any medical stuff, costs plus premiums have to exceed 7.5% of your adjusted gross income. So those are two big hurdles. I have to be itemizing, have to exceed 7.5% of my adjusted gross income. If you get through those two hurdles, then there is an age cap. Now, when you're in your 50s, the deduction's only about $1,500 a year, so it's not that meaningful. Once you get into your 60s, then it jumps up to over $4,500. In your 70s, now it's over $5,000. So it gets more meaningful as you get older, and those deductions are indexed for inflation. Now, where all the magic happens, usually is if I'm working with a business owner, because this is considered health insurance. It's an eligible business expense, so it can be an above the line deduction. So we're avoiding the itemization requirement, we're avoiding the AGI requirement, comes right off the top. And even better, if it's a joint policy and we're using business dollars, it's a full deduction for the business because employer paid health insurance for a spouse, even if they're not employed by the business, is still deductible. So I see a lot of small business owners where it's husband and wife and we use business dollars and the business can get a deduction. Now, of course, the C corporations where all the magic happens, we do a lot of these where it's an executive bonus plan, or we're doing executive carve out and covering those key executives and getting the business a full deduction. So that's usually a conversation I'm having with the CPA to figure out where we can get that deduction.
Yeah, that's some really interesting things to think about. Absolutely. Thank you, Mike. We are just about out of time. I want to make sure that we get you out of here on time for whatever else you got going on tonight. But thank you both for being here. Thank you for attending Method to My Money in Sickness and in Health, Planning for Healthcare Costs in Retirement. Also, we never charge a fee to sit down and talk with anyone. The first initial conversation is always free. If you go to our website, www.canon-wealth.com, you can click a little button there called Schedule a Call. And there you'll be able to schedule a call with an advisor, and there's no cost whatsoever for that consultation. And then if we can help answer your questions, give you some ideas, give you some guidance. If you'd like, we could even put a plan in place for you to be prepared for this sort of thing so that you'll feel good about healthcare costs in retirement. Again, thank you for joining us. We're going to sign off, and we'll join you again next time, which would be in April, the second Tuesday in April at 6 p.m. And until then, hope you have a great evening, and let us know how we can help you.